right, ladies and gentlemen, it's 12 o'clock. You are on time. We're going to go ahead and jump in. We hope you had a wonderful Thanksgiving break. I am Destiny Fernandez, the Marketing Manager at Catalyst Funding, if you're new or joining us for the first time. Before we dive in, I do want to remind you that the webinar is being recorded, and we will send you a copy tomorrow via email. If you have any questions during the webinar, during the call, while our speakers are going over the slides, put them in the questions box. It should be on the right or left-hand side of your screen, depending on what device you're using. And we will answer those towards the end of the webinar, generally around the last 10 minutes or so. If you have a question that is very deal specific, maybe it's a deal you're actively working on, we will go ahead and direct you to one of our fully licensed loan officers so that they can communicate with you about that specific deal. We also have a disclaimer. This webinar is intended to be helpful for you. We love sharing this information and helping investors keep an eye on the ever-changing market. However, Catalyst, our associates, and guests are not liable for any investment decisions you make hereafter. Please always conduct your own due diligence before moving with any deal, or feel free to, again, contact us and speak directly with one of our trusted advisors or fully licensed loan officers. All right, let's go ahead and get started. I'm so excited to introduce you to one of our guest speakers, Steve Liang. He's the founder and CEO of Real Estate IQ. Steve, welcome.
Hey, thank you. Thank you for having me.
So I'm going to say a couple quick things about Steve. We've worked with his organization for quite a while. They do a great job with providing tools to real estate investors. If you have not worked with Steve and his team thus far, we strongly encourage you to reach out to them. They're at most of the events across the state of Texas, but they also have a national footprint. They're making a big impact for real estate investors all over the country. So welcome aboard, Steve. Glad
Thank you. Thank you, Wade. Thank you for the introduction.
Sure.
Glad to be here.
Anything else you want to add about what your company does that
oh, yeah.
No?
Thank you. Thank you. So Real Estate IQ, we are focused on offering data solutions for the real estate investment industry. We kind of look at it from an ecosystem standpoint. If you're a real estate investor, right, there's a whole value chain that you're doing. We are finding deals. We have to validate the deals. And then there's also deal making, which a lot of times involves funding to make the deal happen. So we kind of look at it from this standpoint, and our focus is going to be on how we can use data and to make data-driven decisions so you can save time, energy, and money that can fit your investment appetite, strategy, and budget. What's very interesting, you know, these past 2 years with Real Estate IQ, we are actually going through a big maturation process. And this is how powerful data is. You can use data to do marketing and find out who you want to reach out to. We also started digging into our own operational data. We actually brought in a data scientist, and we have a team of data miners as well, just really looking at our data and really polish the ones that are working and stop supporting the ones that are not. So we have been making a lot of big changes and kind of evolving ourselves to grow to a mid-sized company. And I think there's a lot of value there, whether, you know, no matter where you are in your investment journey, either you're starting and you need to find deals, or you need to find more deals and how to optimize your operation. That's what we're here for. We want to, you know, give a really big support to the real estate investment industry with our kind of expertise in data and analytics and insight. So, you know, also looking forward to this talk today. I look forward to meeting everybody. Thank you.
Great.
And as we go on, if anybody wanted Steve's contact information, we will have that on the last slide so you guys can learn a little bit more about Real Estate IQ. Definitely check out their website as well. And if you're joining us for the first time, let me introduce you to our other speakers and experts in the space. First, I'm going to introduce you to Wade Comeaux, our founder and CEO. Hey, Wade. Wade started his career in 1995 in lending and management. He has had titles such as president and vice president, leading sales operations team of up to 1,400 employees. He's a licensed real estate agent and active investor himself, which gives him an expertise in the market, as well as sharing his personal experience to clients that come aboard. And we also have our director of lending, Jeff Johnson. Hey, Jeff. Jeff manages all of our lending operations within Catalyst. So if you are working with us or have worked with us, chances are Jeff has overseen your deal or has contacted you directly. He also works with all of our loan officers and helps deals go smoothly in-house. All right, well, without further ado, we're going to jump into this market update, and I'm so excited. Before we do, I just want to make sure we just see the presentation on the screen, right? Or can you see the buttons and everything? I know we jumped in a little bit early, but is the view okay for you guys?
Looks good to me.
All right, well, we'll get started.
I'll cover this quickly. For those of you that may not know, Catalyst is a lender. We try to be focused in all important areas of both short-term and long-term financing for real estate investors. So we provide hard money, which is the money to purchase and repair distressed real estate, as well as long-term financing for cash flowing properties. As Destiny mentioned, we are lenders built by real estate investors. Many of our teammates have invested in properties, and we also own a pretty large portfolio of ourselves. We've been involved in flips, assignments, the whole gamut. We try to bring that information to help you succeed. We have a single point of contact model, which we do think is a little bit unique in comparison to most of our competitors. That means that you have one loan officer who can provide all of these different products, and they're experts and not trying to put you into products that may not be best for you and your goals, but really try to look at your goals and needs and find the products that best fit them. We average 5-star reviews on all of our social media outlets, including Google and Facebook. And we offer also the entire gamut of primary or owner-occupied property options as well. For example, primary refinances, people are doing a ton of those right now. Rates are still low. You're able to take that debt equity in your home, which candidly, almost everybody has. When you look at the statistics on appreciation over the last couple of years, it's shocking. I think I saw 20% since COVID on average nationwide, which is pretty amazing. So if you've owned a home since COVID began, then you have 20% equity in your home. So there's an opportunity for you to use that equity to invest in real estate. We also have 2 products that we're really excited about. One are non-qualified mortgages. If you've ever had difficulty getting qualified to do long-term holds, this is a great product for you that requires no income documentation. Blanket loans fall into that same category, no income documentation required, but you can do loans of up to 10 million, sometimes 100 properties. It's a very exciting product that allows you to have one easy payment for multiple properties, or if you have the capital to do it, you could go out and buy an entire portfolio of loans and start cash flowing on a large scale immediately. We also have some exciting Airbnb loans. Those are often more difficult to qualify for, but those are cash flowing with incredible numbers right now. That's arguably the hottest category in the single family investment space, this Airbnb. So if you have had difficulty getting qualified for that, definitely check us out.
Yeah, I was going to say, Steve, are you coming across a lot of that with your people?
A lot of what people?
Are you coming across a lot of Airbnb products with your customers?
Yeah. Actually, I'm very curious about this Airbnb loan and how it works. Would you tell us more about it?
Yeah, the big thing is that there's usually 2 ways you have to qualify for loan products. If it's a conforming loan, then you are qualifying on your own ability to pay that mortgage, right? Conversely, if you're doing a non-QM loan, there is no income documentation, but the property itself must cash flow. So it's called a debt service coverage ratio requirement. That often is difficult to meet on these Airbnb properties because you may have $1 million home where you can lease it on a short-term basis and make enormous returns, but you do not have a long-term lease in order to use to qualify for that debt service coverage ratio. So Wall Street is very excited about this category, and they're bringing out products that require neither a long-term lease or your own proven ability to pay that entire mortgage. Because even if people are pretty well capitalized, they make good income, they may not be able to cover another mortgage for $1 million property in Colorado or down in Galveston or whatever the case may be. So this does allow you to get into the space primarily based on your FICO alone. The LTVs can often be lower, but it's still very exciting to get into this space without having the property needing to qualify or your own individual income to qualify.
Wow, that's amazing.
Yes.
Airbnb has blown up a lot. We were actually just at another international talk to international investors, and we were sharing that Airbnb, like rental arbitrage, has become a big thing, especially for the younger type of investors, because now you can kind of operate like a hotel business for somebody and make cash flow. I think there's so many ways you can creatively apply here. I look forward to learning more.
Yeah, just a quick story. Anecdotally, we have a borrower in the San Antonio area who's cash flowing $300-400 a month for years on a long-term lease. Now, she does happen to be close to something that's attractive, both the medical area as well as Fiesta, Texas. But she took that same property, and she has relayed to us that she's cash flowing like $7,000 a month in peak season and $5,000 in off peak. So that's kind of amazing. Whenever you hear those numbers, they almost sound dumbfounding and hard to believe, but that's not an isolated story that we've heard. The numbers can get really huge whenever you can lease it out for several $100 a night, like a hotel would, just like you said, like $500 a night. The returns can be incredible. Okay.
Yeah. I always assumed that, I always assumed that Airbnb had to have some kind of special feature, like had to be on the beach or had to be, like you said, near a location. There's a lot of properties that are just plain old houses in the suburbs that people are Airbnb-ing and making a good amount of money as well. So don't think that if you have a property you want to consider Airbnb, it doesn't have to be a beach house. It can, take a look at it, do your research, but it can be just a regular rental house. Okay, so this is a chart. There are a handful of factors that are going into the run-up we've had over the last year with regards to why prices are so high. And one of the factors that we talk about is housing starts, just the availability of inventory. And we show this chart to kind of give some perspective on how little building has been going on in the last 10 years. You can see a pretty rapid increase from that dip all the way down to 2020 and then up to where we are today. So they are trying to play catch up and start building more units. But if you look at this, you can see historically each decade all the way back to I believe it's the 50s, the last 10 years were the fewest homes were built in the last 10 years than any previous decade. So that is, obviously there's other factors at play with why the prices are up so high, but this is a large factor. It's just simply there's not enough inventory that was built in the last 10 years. Obviously the population's growing. We can talk about the age of the home buying population and how that's kind of blown up. But this is something we always show just to kind of give some perspective. But one of the reasons why values are so high is because of the lack of inventory.
Mm-hmm. Very
Next
good.
slide.
So another major factor out there that everyone needs to keep an eye on are interest rates, right? Interest rates have a direct correlation to how people, to the price point of a home that people can afford. If you have a very low interest rate, you can afford more of a home. If interest rates increase, you can afford less of a home. So that is going to be a factor that we all need to keep an eye on. And if you don't necessarily know exactly how inflation can impact that, whenever there is rising inflation, people expect a higher return on their bonds, right? Because that purchasing power is reduced. So inflation is a driver that is causing people to want high returns on their bonds, which can also impact, of course, interest rates. In addition to that, the Fed has already announced that they're going to reduce their bond buying. I think it was 15 billion. And so that is a big impact as well. And they're planning it. They have a defined plan to taper it down to where they're no longer going to buy those bonds. Then if they also alter the overnight lending rate, which is the two primary levers for impacting inflation, then you could see interest rate increase over time. One thing to keep in mind, and it's really cool how this gap is spread. If you look, the blue and the black lines were almost identical for quite a bit of time. That is the black line being 30-year fixed interest rate and the blue line being 5-year ARMs. One thing, you can see that gap spreading right now, and that's because of where people anticipate interest rates going. The good news is a lot of people pursue this buy, rent, refinance, repeat, or sell potentially, the BRRR method, or a lot of big mentorship organizations teach you to keep the homes 5 years, either refinance, sell, move into bigger properties, whatever the case may be. If you're looking at doing that, it's important to keep in mind that you can use 5-year ARMs for that, and the rates are still incredibly attractive. Not that 3.1 is bad by any means, right? Now this is owner-occupied mortgages. There is a higher interest rate associated with non-owners, but at the end of the day, rates are still historically low. But look at that spread and keep ARMs in mind if you have a short-term investment horizon. What are you seeing out there? What are any of the people you're working with, Steve, commenting on interest rates and how it's impacting their decisions?
Oh yeah. So I think there's we talk about this, and there's also combining with the pandemic, the savings rate has gone up like crazy. So a lot of folks that have like a W-2 job, very easy to get mortgage, low rate, plus they have a chunk of saving, and that has been driving up the part of the high demand for the millennials demanding pricing and buying these houses too. So we're looking at record low month inventory in some counties. They are less than 1 month. I think there are a couple of Florida counties less than 1 month of inventory in the market, and in the Texas area, oh my goodness, it's also very low inventory right now. So hot market, and driven by these mortgage rate. We actually purchased a property earlier this year as well, to take advantage of the low interest rate. And we're considering getting more next year.
Absolutely. Before we move on from this slide, it was a funny quote. I thought this Holden Lewis is a really interesting article in the Washington Post, but it said, higher inflation summons higher mortgage rates just as surely as baked beans invite ants to a picnic. So we've been talking about this for some time. It is going to increase interest rates over time. We're already starting to see it. Interest rates have gone up recently, but there are alternatives. The ARMs are another alternative. But whenever you're looking, we'll show another chart in a minute, I believe, that rates are still incredibly low historically. Rates were at high as 18% in the 1980s. So you can still take advantage of incredibly low interest rates. And at the end of the day, it's all a function of how can you make money in investments, right? And as long as interest rate is just a factor in your cost, it's not the only factor. And people are still crushing cash flows at purchase, not even including appreciation and future interest rate, future rate increases. They're cash flowing $300, $400, $500 a month. So that's a great return on investment. Next slide, please.
So this, and Steve, this is probably your biggest area of expertise, is my guess. So where the housing market is going in 2022, there was an article, I believe it was on Fortune, that polled maybe 7 large organizations and where they thought the housing market was going to go. I believe all but one had a positive forecast. This is the one. This is the Mortgage Bankers Association had a negative 2.5, but all but one had a positive forecast, and a lot of them had significantly positive forecasts. Goldman Sachs and I believe, I don't remember who the other one was, but it was Goldman Sachs and maybe Zillow had 13.5% increases, right? And this is on top of the fact that this year it's been right at 20% nationwide. I think it was August, they measured August 20 to August 21, and the overall appreciation across the country was at 19.9%. So think about that for a second. You're getting 20-year growth in 1 year, right? And just I'll hit some of these quotes and then we can talk about it, but the supply demand picture that has been basis for our call remains intact. This is the part that I thought was interesting, of all the shortages afflicting the US economy, the housing shortage might last the longest. But that was very interesting. 2, we're in the midst of a 5-year period, and this is kind of what we were talking about earlier. We're in the midst of a 5-year period in which the 5 largest millennial birth years are hitting the important first-time home buying age of 30. So, and then lastly, Fannie and Freddie are predicting US home price growth between 7 to 8%. So when you factor in so many more people are hitting the home buying age. The other thing I saw in a previous article is I think the median FICO score for society is the highest it's ever been. Debt ratios have gone down significantly. They're in the low to mid 30s, I believe, and the debt ratio is basically the ability to the income relative to your bills. So the financial health of everybody is strong, relative, average wise. So you have a lot of eligible buyers, a lot of people that are in their 30s wanting to buy homes. You've had a decade of nobody building, and then you have the pandemic where people realize they can work from home, they want more space, so they're kind of spreading out and not so clustered on the urban markets. It's creating this, I think they called it a storm of mass appreciation. I don't know, Steve, if you had thoughts on this, or this is kind of the same thing you've been seeing.
Yeah, I've been seeing that too. It's very interesting. I feel I was very well prepared for this content because we just did some research on this. So let me share some national numbers of let's say home sales, right? Talking about the high demand. In October 2021, it was 5.66 million. And comparing to the last month, it grew. And comparing to, let's say, 2020, a year ago, it grew by 11%. So we're seeing a lot of transactions happening. We talked about monthly inventory. Nationally, the monthly inventory is 2.3. And last year, at 3 months inventory around the same period, we were already saying it's a big, seller's market, hot market. Now it's even hotter.
Absolutely. We wanted to show this particular article because of the range. Like you look on this first page and it shows a reduction by the Mortgage Bankers Association and this is honestly the first time I've seen anybody say a reduction of this size, 2.5%. But you go through all these, there's 7 different models and they all have a vastly different opinion. Fannie Freddie says 7 to 8%. Goldman Sachs, I think, said 16%. Next slide. You have Redfin saying growth of 3%. Zillow's forecast here is, let's see, that's
like 13, I think.
13, 14. So
13, yeah.
The moral of this story is this, in my opinion. Real estate may go down in the short run, potentially, but it's still up 20% from the beginning of the pandemic, which means it's still doing very well. And there are so many factors that are leading to these numbers. More people that want to buy homes, fewer homes that were built for a very, very long time. And to Jeff's point, very strong capability of people to buy. And a lot of people talked about the potential of this major foreclosure boom, which because the government has already said that they're going to allow people to tack payments onto the end of their forbearance agreement their end of their mortgage, I apologize, rather than having to pay it all immediately. Back in 2007, 2008, the difference was if someone didn't pay a mortgage for 12 months, they had to make all 12 months payments in 1 month, which is kind of crazy and impossible. Conversely, this time they're allowing them to tag it onto the end, and there's so much appreciation this go around that if even someone can't get qualified to rework their mortgage, they can just sell the home. There's so much appreciation there at the moment, right? So even if home prices drop by 10%, people still probably have owned their home for a while, so it's up 10% from when they bought it, right? So they still should be able to sell it. So it is a different feel this time. Home prices would really have to drop significantly to see this foreclosure boom. So I tend to lean more in the middle of these. I would be surprised at 13% again year over year, in my opinion. It's been so hot, but I also personally don't see a drop. That's just my guess. But I see it being a little bit more steady appreciation, but still higher than the historical averages. I don't know if you have a guess on that either, Steve, but that's mine.
Yeah, the way I'm looking at it, talking about housing forecasts, it's 2 major factors, which we already covered here. It's the mortgage rate that's going to drive demand. We're oversimplifying, of course. And how many new homes are being built? How much housing is being supplied in the market? Because of that big drop in new home build in the last decade, we're still trying to play catch up. So I think as long as we're still, needing housing, what we need to do is, I'm going to repeat the same point that you guys brought up earlier, which is cash flow. If you have good cash flow, you're gonna do very well. As a real estate investor, I like to look at it with a long-term mindset, and on average, housing doubles in value every 20 years. Places like DFW, Houston, we have grown a lot. Like I think prices double in the last 10 years. So if we have that long-term mindset, I think it's always a good time to buy.
Yeah, and we didn't cover it this time, but it is also separated by states, right? You mentioned Florida earlier, Texas, low state income tax states and states that have more business-friendly environments are really seeing a huge move in population, huge population growth. So I think we're fortunate to be in a state where there is a lot of movement in. That means a lot of major corporations are moving in, a lot of people are moving in that need homes, and that's going to also have a factor. So the national numbers still look strong. I can see more reductions on a national level. I think in those stronger states where so many people are wanting to move there, it's going to be even more difficult to forecast a reduction in values anytime in the near future.
I agree. We're looking at these are the kind of 5 major factors on like places to be. Like we're so fortunate to be in Texas, which is such a big growing state. We looked at the size of the economy. You guys know that Texas is now number 9 in the world. Previously, we were number 10, so we got a higher rank because of all these high-tech companies coming in. So a couple of big news that just happened in the past a couple of weeks. Samsung is investing $17 billion in Taylor to build their semiconductor chip plant. Texas Instrument also committed $30 billion to build Sherman. So those two are North Texas. And Austin, Houston, the high tech is blowing up. There's a lot of headquarters that are moving to Texas. So I think we're going to continue to experience this boom. So we talk about the economy, we talk about job growth, we talk about population growth. I think all these are all very bullish factors to be looking at Texas and a couple of other states as well.
Absolutely. Well, one last thing.
So when you say Texas is 9th?
9th, yeah.
So when you say Texas is 9th, are you saying it like if Texas were its own economy, it would be 9th in the world? Is that what you're saying?
Correct. Yeah. Our GDP, number 9 in the world.
Awesome.
Like, wow.
That's awesome.
I grew up in California, and California was always ranked high, and now we have Texas too. And I live in Texas. I'm not Texas.
All right. I think we're ready for the next slide here. Well, I don't know if we covered that
one.
Go back
yet.
One? Yeah, go back one.
Yeah, we didn't cover that one.
Back one slide, please. Yeah, thank you. Okay. Steve was just talking about this a little bit ago, months of inventory. 6 months is equilibrium, right? That's a steady state, not bad, not good. We're at 1.6 across the state. That's an incredible number because you have a lot of very rural markets that are baking into this, right? Whenever you're looking at your major markets, where most investors will probably be investing, those numbers are even stronger. We'll show those in a minute. Texas days on market did increase slightly to 30 days. It's kind of funny. We've been so hot for a while that we're forgetting that there's seasonality involved, right? I mean, we are going into the winter. That's always impacted things. So it's, I think, somewhat expected. I don't know that that's necessarily a horrible trend if you go into the winter months and there is a little bit of a slowdown. Texas median home price increased for the 9th straight month, increasing 16.8% year over year, record-breaking 310,000 across the state, again, including a lot of rural markets there. And repeat sales home price index climbed to 18.2% year over year, double-digit growth for 5 consecutive months to 14.9%. And you look at the different cities there: Austin 36.1, Dallas 22.9, Fort Worth 20, and San Antonio 17.2. So this data comes from Texas A&M. We always get great data from there, but they really look at things on a statewide level, so it gives a good high-level overview before we dive into our cities in a little bit. We always cover the 4 major cities as well. Anything to add on that one, Steve?
No. I wanted to maybe chime another point I wanted to bring up, talk about cash flow. The national rent growth for 1-bedroom apartments has grown by 12% in the past 12 months. And for 2-bedroom, almost 15%. So we're talking about cash flowing, buying properties for cash flow. That's going to be the the topic for 2022, I believe.
No doubt.
I'm jumping on that bandwagon.
I think savvy investors are, for sure.
So this is something we cover, the Texas Residential Constructive Index. It's basically, like we said, how much is Texas building? And so it's two lines. The blue is Texas. There's a baseline of 100, right? So they just said, okay, back in 2000, whatever's happening, that's the baseline of 100. And so you see the trend line relative to that point in time. Texas is in the blue, US is in the red. So you can see, you know, for the most part, Texas has been outpacing the US along this chart ever since the mid 2000s. It looks like Texas took the lead and they've been leading ever since. So we are building at a higher clip than the rest of the country. But if you look at the leading index, that's, you know, I don't know all the details of what that entails, but it's basically saying, okay, what's the red and the blue, what's being built now, the green is a predictor of what's going to be built in the future. So if you can look at that spike right around 2020 in the green, shot up significantly over the last year. So I think the inventory is going to start coming online here pretty soon. It's just a question of if it will be enough to start driving prices down. That's going to be the big indicator because, you know, like I said, it's for the last year, the home builders have been gearing up and trying to catch up to make some money. It's just a matter of will it be enough to bring prices back down to a normal appreciation number.
So maybe if I could add one more piece of data, and this was published earlier this year. We were talking about population growth, and Texas is #1 in the year 2020. A lot of folks moved here. Of course, people moved to Utah, you know, other states, but Texas was #1. And the latest number we were able to find is 374,000 migrated to Texas in the year 2020. That's followed by Florida, which is 241,000. So a lot of people are moving to Texas. We're almost double, right? Or maybe it's a little less than double than Florida. I think the housing demand is going to continue to be very high here in Texas. There's no state income tax. There's so many advantages to be in Texas. So I'm kind of bullish. You see my wall art. I'm gonna change my backdrop soon, but you know, I'm still very bullish as a person.
We'll know to short the stock market if we see a bear back there next time, right?
I'm just gonna call you every so often. Just show me the back of your wall there, so I can get some tips.
Yeah. Okay.
This next slide is showing the major metros' existing home days on market. You can see just a massive drop from 2011 when the market was still feeling the effects of the mortgage crisis back in that time frame. But it's been a steady downward decrease. But then, you know, whenever COVID kicked in, you could just see days on market just dropped tremendously for all the reasons we've been talking about, including, especially early on, people's desire to have more space, get out of apartments, get out of the cities. So, but that trend, it's not dropping as rapidly as it was before. You can kind of see it starting to flatten a little bit. I mean, you can't go to zero, right? But yeah, I think still very strong there. And then one thing that we've been noticing, this narrowing gap between existing home sale price and new home sale price. And that is great for flippers, right? Because you can get a premium on these homes whenever you flip them. Their prices just keep going up. And then also for people who are long-term holders, right? It's just there's not enough inventory for people to say, I'm going to take the new house every time. There's just not enough of them. So home prices on existing properties, especially if you do them well, are really increasing at a rapid pace. And there's almost no gap in between the two right now, which is pretty amazing.
This reminds me a little bit of my days in California. I was a teenager when I was living in California, and a lot of older homes and new homes, there's not that much of a price difference because a lot of folks just go in, you know, kind of gut it and kind of rebuild it. So the reason I want to share that is there's a lot of Californians that have moved to Texas, and they're not as sensitive about just buying new homes. They're also open to older homes, like this place we just recently moved to, 30 years old. And also, I guess, because I'm in the investment industry, it's very easy to, remodel and do all this. So I don't know if there's a correlation here, but I think that's really good news to have, again, for flippers.
Yep.
Very nice.
So we kind of referenced this earlier. We always show this to give people a little perspective on how lucky we are right now with regards to the interest rates. As you can see from the 70s all the way to today, had that massive spike in the 80s, and then it's just been a steady decline all the way to the point where we are now. The average 30-year fixed rate for bank rate is 3.25. That is actually a little bit higher than it was recently, but still, when you look relatively speaking historically, really, really low. So it's just making it that much easier to buy deals, right, and hold on to them and cash flow. I think the previous prediction, the most bearish of the groups, the main reason why they had a significantly more negative outlook was they thought rates would be around 4% this time next year. So that is one thing to keep an eye on. As rates go up, that might start squeezing out home buyers, right? There's going to be a limited supply of people that can afford homes at those levels. But that was the justification. But like I said, still extremely, extremely cheap money right now. So now is a good time. Next slide.
So here we deep dive Texas. Very interested to get Steve's feelings on this. The couple things here that I do think jump out. Total number of sales was down. I don't know that that is an indication of like the market softening by any means. It's just, the total number of active listings is down significantly as well from last year. So I think that's an inventory challenge more than a softening challenge by any means. And you can see that from days on market still being down significantly year over year, prices being up significantly year over year, up 13.1% on the average, up 14.7% on the median. Months of inventory still down significantly, 2.3 to 1.8. Pending sales is higher than this time last year. So I think some positive things going into the months of November and December. And the single family rentals, I think this is really interesting. You see the rents are up 9.7%. I think Steve mentioned earlier, maybe larger numbers nationally. But one thing that's really interesting about this is you look at where it went. Pre-COVID, 1768, and then now it's 2115, right? So you're talking, what's that, 300 and some odd dollars right there. So a lot of people buy a property with the intention of cash flowing $300 or $400. So what does that translate to? I know it seems like it's only up 10%, but it translates to potentially doubling your cash flow. Now you got to bake some other things in. Taxes are probably up almost everywhere. So that does bake into this. I do not think it's made up $350 in additional cash flow that the average person renting properties in Houston has done. It's not made up that much, right? So those are really exciting statistics for long-term investors. Anything you see there, Steve, jumps out?
No, not much comment here. I was just thinking that with Airbnb, the potential cash flow can be better. That's basically it. And I'm looking at these numbers. That's very exciting. Wow.
Yeah, I know a lot of folks have a kind of a preconceived notion about their price point for rentals. I think these numbers would suggest that although taxes go up as well, I think the ability to charge more rent would lead me to believe that people should kind of shift their numbers up a little bit, and still maybe a little more expensive homes can still cash flow. Because I know there was a while there where you'd say, okay, if anything above this number, it's not going to make any money, it's not worth it. But I think as these rents go up, you can see that you can cash flow at even with more expensive properties than in the past.
One thing that I want to maybe bring up, and it could be potentially interesting, is that a lot of funds are buying out single-family rentals to rent it out. It has been very big in cities like Atlanta, and it's starting to kind of pick up in the DFW and Houston too. I personally know a couple of funds acquisition folks. and how that might impact, or if they are just kind of feeding this housing frenzy with millennials needing to upsize and needing to have single family homes instead of living in an apartment. I don't know.
That's a good point.
Just something to observe, I guess, over time.
No doubt. Next slide, please.
So this is, so this is the Houston market broken out by segment. I always find it very interesting, especially when the prices really started going up. You'd see these massive changes, but this is still, we're kind of a year out of it already. The 0 to 99,000 was down 21%. 100,000 to 150 down 42%, 150 to 250 down 39%. That is simply just a function of the fact that you cannot find houses at those price points. It's become more and more difficult because if you look at the top three cohorts, the 250 to 500,000 up 17%, 500,000 to 1 million up 23%, and then 1 million up 20%. So it's just the natural shift of everything being more expensive. You're going to see these numbers exacerbated until things settle down. Next.
So San Antonio, in my opinion, one of the definite top 2 markets for long-term buy and hold investors in the greater Texas area. Still very affordable. That affordability index that we often look at is still very strong there. They also had a reduction in total sales, but big increase in price year over year, 16% on the average, 18% on the median, a little stronger than Houston in that category. Big increase in price per square foot year over year. Days on market down 41%, which is pretty amazing. And you see the reason that there are less sales. Same thing as Houston. Far fewer listings, I think I saw somewhere else. I don't know that this necessarily breaks this comparison down. But in the rental space, you can see days on market down significantly, and the sales are down, but the price is up 10%. So Texas overall not up quite as much as some of the national numbers on rentals. I don't know if it's because the market is a little bit easier to buy in potentially because the price points aren't so outrageous. But that seems to be a little bit below the national averages that Steve was talking about on price appreciation. Anything you're hearing in that San Antonio market that jumps out to you, Steve?
No, I'm studying. I actually took a screenshot. Thank you. I'll study that a little more later. Interesting. And I always so obviously, all the Texas markets are fantastic. I think Houston, I see it as easy to get in terms of price point and a lot of potential renters. That's just my impression. And also San Antonio growing as a big piece of kind of potential growth. San Antonio is the number 2 biggest a city in Texas behind Houston, I think, and their home prices are still relatively low. Yeah. So there's opportunities in San Antonio.
Yeah. To your point, I think Dallas, obviously Austin's the hottest market by far in Texas, but the price point's so high, sometimes it's difficult to have a cash flowing long-term rental. But I will say, that's a fantastic market because it's also such of a vacation destination as is San Antonio for the VRBO Airbnb type rentals. Really hot market there.
Yeah, yes, sir.
Yeah. Where do you live? What part of town or part of the state, Steve? Do you live up in Dallas or down here in Houston?
Yeah, I'm in Dallas.
Okay.
I'm in Dallas.
Okay.
I just had a baby 2 years ago, so we're now in the suburbs. I used to live closer to the city. Now I'm enjoying the peacefulness of the suburbs.
There you go. Nice. So this is the North Texas report, your home. So if you notice, the median price is $310. Everyone, I hear that Dallas is a more expensive market than Houston. I think that maybe is Dallas proper because the median price in Houston is $305. I think North Texas is the general area at $310. So it's very similar to Houston. up 15%. I think the price distribution is pretty cool. This is the only market that breaks it down like that, where you can see where the houses are selling, right? So over half of the properties are sold in that 200 to 400 range. Then you have outliers on both sides, but half the properties you find in Dallas are between 200 and 400. Active listings up 17%. Closed sales down. Again, I think that's more of a function of inventory than anything else. I think the velocity is still there. If you look at the months of inventory, it's down to 1.6. Same thing. Houston's at 1.8, so it's a little bit hotter than Houston, relatively speaking. And then 31 days on market, 70 to close, 17 less days than October. So more of the same you see in Dallas across the state. Next slide.
Austin, as we mentioned earlier, definitely an incredibly hot market. It's getting national notoriety, talked about with regularity in the national media, because so many of the tech companies have moved to the greater Austin area. It's a great area for tech companies, very business friendly, lower tax rates, but also a lot of people who have expertise in that particular space, so it's doing incredibly well. Median sales price up 24% year over year. That's definitely the strongest number in Texas by far. Average days on market 16. That's incredible to be that low. And under right at 1 month of inventory, it was as low as 0.6, I think, in the past. But I think some seasonality is kicking in, maybe a little bit of cooling in the market, which is still just uber hot. And then you look at the new listings, relatively flat, active listings flat, pending sales up. So still a very, very hot market, maybe cooling slightly. And I wonder how much of that is seasonality and if you'll see that really bounce back whenever you get out of the winter months. But in my opinion, as I mentioned earlier, you can only be this hot for so long. So I do think over time it will slow a bit.
Yeah, there was a couple of slides ago. It was something that I just thought about. It was crazy. In Austin, they said the existing home increase year over year was like 36%. So just think about that. If you have a house in Austin worth $300,000 a year ago, that property is worth over $400,000 in just 1 year. So you've made over $100,000 in equity just on that one property in Austin, and that's below average relative to this. So it's even a little more pronounced than that. That's crazy. Next slide. So Steve, I know you have some nationwide clients, right? A little more nationwide focus. So this is the Affordability Index we always throw in there, and it's basically what it measures is it's the measure of the average mortgage payment relative to the average income level in the city, right? So how much, if you live in this city, how much of your income has to go towards your mortgage payment is basically what it's telling you. So if you look at the top 5, 82% New York, now that's insane, right? The New York, Miami, LA, Jersey, San Francisco, the top 5 really doesn't change much. Then you start bleeding down to Texas, right? You have Austin up there at 20, Dallas 21, Houston a little further behind, 27. I always like to look at the bottom. A lot of those markets, El Paso, Garland, Plano, Corpus, like some of those, maybe not Plano so much, but a lot of those markets that are a little cheaper, I would see those as great opportunities for buying and for cash flowing properties, right? When you're down there and it's very affordable to buy a house, it's a great place to stock up on some rental properties because it's very cheap. And there's, as you saw earlier, rents are going up across the board everywhere. So I don't know if this is expected, Steve, if you look at this thing and this is about what you would think when you look at your nationwide data, but it's pretty consistent, the top 5 for sure.
Yeah. Those top 5 markets are fantastic if you already own a lot of properties. Yeah, like you're already established. Oh my gosh, that's a really good place to be. And I think Texas, we see all these Texan cities in the more affordable part of this chart. I think that's extremely exciting for acquisition. for those who are in acquisition mode.
Yeah. Another key thing to keep in mind is without having, this is a gross tax, gross income, not a net income. So whenever these numbers are even more difficult in those major cities in California, because you're also having a 13% state income tax. So you have less of that 63,000 made in New York. You have less of that 62,000 made in Los Angeles that you can actually spend towards your mortgage payment because of those taxes. So that gap is even wider when you think about the affordability for the state. And that's why I really believe that it's hard to see it going down significantly in these markets because it's so affordable. People have an opportunity to move. They very well may, just because you can cut your housing expenses so significantly and have money to spend in other areas, right? Next slide. Or is that a wrap?
I think that's a wrap.
Look at that.
Look at that. And we were right on time. We normally try to leave 10 minutes for questions. The last few webinars, we've been cutting it very close. So awesome, guys. Thank you so much. Everybody, if you are interested in learning more about Steve and his company, his information is on the screen as well as ours. So if you have a particular deal that you want to contact us about, please write down this information, screenshot it, or you can wait until tomorrow when you get a copy of this webinar. So a couple of housekeeping things we need to do. We need to pick our winner. And so I put everybody's names that joins us live into a randomizer and it picks someone out. So it looks like our winner for the half off your hard money processing fee is Cole Layson. Congratulations. Get ready to kick off 2022 with a new deal and an investment. So we're excited for that. And now we'll jump into questions. So my first question that I see here, well, actually, this isn't the first question, but I'm going to go ahead and answer this one. Will you go back to the last Thursday of the month? Yes, we will. We only moved our webinar to the first Thursday of the month this time because Thanksgiving was last week. We'll be doing it again for December's webinar. We'll be doing that in the first week of January. So we'll be kicking off the year strong. We'll do a full recap and get into the numbers then. The next question I have is, do you see buy and holds shifting to Airbnb being a better investment opportunity or a single family year rental?
Is that for me?
Sure. Go ahead, Steve.
So I can share my experience. We actually have an Airbnb. We kind of started jumping into this this year. Like I said, we moved, and our property is in a pretty desirable area around the city. So we wanted to try out Airbnb. The thing about Airbnb is you need to get it ready for Airbnb, and there's so many creativity when it comes to Airbnb now. Some people are setting up their Airbnb to compare with theme hotels. Like if you have been to small boutique hotels that have some kind of theme, very popular in Europe. Some people are doing that for, I think, Simpsons or something, and they are trying to kind of compete there. Some are competing through, I don't know, location, or we talk about different features. You have to put in a little money, ideally, if you want to increase your occupancy rate. And at the end of the day, if you do long-term rental, more than likely you would get more steady income, unless you have some vacancy that you can't fill. For running an Airbnb, it's really like owning a hotel. So it's all about the occupancy rate and who is operating that space for you. So for the first couple of months, we weren't able to hit our occupancy rate and we were losing money, and we're like, so there's a little more up and down. As you are more profitable, obviously some people are having $7,000-8,000 a month type of income, and they put a lot of work in there too. So maybe having a more realistic expectation. So it's taking a little more risk, but you can potentially make more versus lower risk and a little more steady income. One interesting thing that I want to share, I've been talking to a couple of property managers that started establishing a team that helps people run Airbnbs. is that they can have the operator rent from the owner for a long-term rental. And then the operator is gonna get very incentivized to making a profit, so they could spread the risk. And I'm sure you can make another deal like profit sharing or whatnot also with the manager.
I've heard of that too.
Yeah, we spoke with somebody, I can't remember who it was, but it was about Airbnb, and it was the exact same answer. Was they're training, like, it's an experience, right? Like you said, there's themes, you know, people that put, like, you get like a massage included with it or something like that. It's crazy, but you're right. Like, if you find a good one and you go above and beyond, you can make a lot of money.
It's a hospitality business, and that was hit hard during the pandemic. But Airbnb still seems to be doing quite well, especially the I guess more remote area, more vacation type of Airbnbs. They have been doing really well during the pandemic. So I guess it's interesting. You know, I always like hitting things when they hit bottom and ride a wave. And the hospitality industry has hit bottom, and now it's coming up. So I thought that's an interesting place to be.
For sure.
Yeah, actually, Wade, I think you had sent us the Wall Street Journal article on long-term Airbnbs during the height of quarantine. People were starting to work remote, and they were like, "Well, I'll go work remote in California on the beach." So I remember that was pretty interesting too. It was kind of right after the initial shutdown of Airbnb. So it sounds like it comes down to preference on higher risk or what you're interested in. But thank you. That's a great answer, Steve. All right. Next question I have are housing prices are rising. Is this a result of lack of inventory or inflammation? Or I'm sorry, not inflammation. Help me out with that word, because now that I've said it, I'm not going to unsay it.
Inflation?
Yeah.
Yes. Yep.
Yeah, I think that there are a lot of factors that we covered. Definitely a lack of inventory, more people wanting to buy, more people moving out of cities, more people getting into that 30-year common area where people may buy their first home. Inflation is definitely a factor. And people, I think, want to be in hard assets. You know, I think in inflationary times, hard assets are a good place to be. So I think all those factors are playing in. I don't think you could say one necessarily is having a greater impact than the other.
All right, thank you, Wade. And this is actually our last question. When do you think interest rates will return to what we saw in 2019?
Not anytime soon.
I am of the opinion that they may not for some time.
All right, well, that is a wrap.
I think one of the articles was if you get offered a rate, take it now, because there's a good chance that a month or 2 months, 3 months, you're not going to see those rates. So there's a really good chance rates are going to go up.
Yeah, as we mentioned earlier, there is 30-year high in inflation, 31-year highs in other categories, and the federal government does not want to have rapid inflation. It's not good for the economy. They've probably moved, not probably, I think they've definitely statistically moved slower than in other inflationary times in the recent past. But I think eventually that you're kind of left with no option. And they already started reducing the bond buying. That's one lever that is always going to increase interest rates. We've already seen that. The other one would be increasing their overnight lending rates, and that could also have an impact. They haven't done that yet, but if they do that, then I think you'll see even potentially higher rates. So I am not of the opinion that in the near future, there are no factors that say rates are going to necessarily go down significantly for a long time frame. These things vacillate all over the place. It could go up and down. I'm not saying that, but most of the data indicates the trend is increasing rates, not decreasing rates. So I would encourage you to move quickly if you're that rate sensitive. But even if rates go up 1%, I don't think, if the numbers still work for your cash flow, then it's still a good time to buy, right?
Still historically low.
Yes, amazingly. Wow.
Yeah. Hey guys, I just want to take an opportunity to thank you for inviting me to this session. It's so well organized. I love the conversation and the quality of discussion. Wow. Impressed. Thank you. Thank you so much for having me.
Thank you, Steve.
Awesome. We're so glad to have you. All right, everybody. We will see you guys next month. Have a wonderful holiday. Oh, we'll see you at the beginning of January. Have a wonderful holiday, and we'll see you next year.
Have a great one. Thank you.
Thanks, everybody. Thanks, Steve.
Great year. See you guys. Let's talk later.
Absolutely.
All right.
Catch up.